Hello and welcome to Securities Lending Live. I'm Roy Zimmerhansl. I'm your host today, and we're here to celebrate the fact that we've got through 1,000 subscribers. So I want to first of all say thank you very much to everyone that is a subscriber, and appreciate you taking the time and making the effort to view the videos and then sign up and watch every video that comes out. So today what we're going to do is, as I said, it's going to be an Ask Me Anything session where you can pop any questions that you actually have into the chat. Hopefully this will all work out and we can answer live questions. But the good news is that we have had half a dozen questions come in during the course of the week. People just emailed them into me. And so we'll be discussing those. So even if there's nothing else for you guys to ask me, we'll have something to talk about today. That's the plan. Look, I'm going to do some giveaways as well, because the truth is I wouldn't be here if it wasn't for you. So I'm going to say thank you in a few ways. So I've got 3 different giveaways, and they'll be spread out throughout the full session. 2 of those giveaways will actually be available to people whether or not you are watching live. So there'll be a 1-week time limit where people, whether you're actually doing it live or you want to do it afterwards, you can answer the question that I asked or looking for, and you'll be eligible for a prize. Or there's live ones that are in the chat. So there's one thing that is only for live viewers. The other 2 you'll have until Friday next week to respond. So without any further ado, let me get my slideshow back up. Let me just switch over to that. And hopefully this is the first, actually this is the first YouTube only video that I've done, live stream, I mean. Typically what I've done is I have done live streams from LinkedIn, and then posted them up onto YouTube. And so they've been live sessions, but they've been posted onto YouTube afterwards. So this is the first YouTube only video, because that made sense to me, because of course this is to celebrate live subscribers. So there we go. Now, what I'm going to do is I've brought up a screen here. As I said, we're here to celebrate the 1,000 subscribers. So without any further ado, what I'm going to do is get to the first question. Okay. So the first question is, how much can I expect to earn from lending? Let me just get to that with the slides. Hold on. That's actually not the first question. The first question is, in fact, what is the difference between a principal lending program and an agent lending program? So let me just bring up a slide here. So this shows a typical structure. So in a normal securities lending program, you have a lender. So this might be an institutional investor, such as a pension fund, an insurance company, a sovereign wealth fund. You might have lending agents. So these can be custodian banks that are already holding on to the assets, and they then make them available, but they don't have to be custodian banks. They can be other custodian banks lending assets that are held elsewhere. And there's also a series of specialist intermediaries that only do securities lending activity. So there's a number of these entities, but they're all grouped as and classified as agent. What that means is they're not principal to the transaction. What they do is they arrange the loans on behalf of those institutional investors, and they lend them to the borrowing intermediaries. Excuse me. They lend them to the borrowing intermediaries, which are typically investment banks, principal trading firms, prime brokers. Those are the borrowing intermediaries. And then the shares go on to the end borrowers. They might be the hedge funds that actually need to borrow securities for either directional trading strategies, arbitrage strategies, or for similar reasons. Okay, so in a normal program, the vast majority go investor through their lending agent to the borrowing intermediaries and on to the end borrowers. Now, legally, when the institutional investor makes a loan, even if they use an agent, their counterparty for risk purposes is the borrowing intermediary. So if they are lending to a big investment bank, even if that investment bank turns around and gives the shares to their underlying client, the exposure for that investor is directly to the principal intermediary here, the borrowing intermediary, such as a prime broker. Now, when you add in an agency, a principal program to it, and the question again was, what's the difference between a principal lending program and an agent? I've just explained what an agent program is. A principal program is that institutional investor or retail investor, actually, and that might be a more accurate description of it, because you've got a retail investor lending maybe through their stockbroker, who is their risk counterparty, right? What that stockbroker does with it, who they lend those securities to, is not really a choice by that investor, and it's also not their concern. What they're concerned with is that the broker or whatever principal intermediary they're using, and there are some institutional investors that go through institutional programs where banks might act as the principal counterparty, but it's up to them then. They carry the risk of who they lend it to and what the terms and conditions and collateralization is. So the difference between the two programs is whether that investor who's lending their securities takes risk on the underlying counterparty that borrows the securities, or whether they're taking the risk that their service provider is their counterparty. So that's the key question that they need to ask, and that's where their risk is. So it's all driven by the risk. The end use here is always going to be the same, irrespective of which program you go through. It's about who that investor who's making their shares and bonds available, who their risk counterparty is. So that's the difference between a principal lending program and an agent program. And I just got a thank you through, so let me just show that up. Appreciate, I know you're a relatively new viewer, so thanks very much. Appreciate you watching and subscribing. So thanks again. Anyway, so that's question number one. Let me just put that away. Right, now, hopefully that makes some sense to the person that asked that question. Question number two is a great question. Does securities lending lead to market volatility? That's a great question. Now, let me just start before I go to some slides. Securities lending itself doesn't really add any kind of risk to anything, because of course, whoever's lending them out has risk, but there is no borrowing activity without the underlying trading activity, and securities lending often goes to support short selling activity, but not every stock loan is to support a short sale. There are other reasons that people borrow stocks and bonds. Equities, the majority of the reason is, of course, for support for the settlement of short selling transactions. So maybe rather than ask about whether securities lending adds market volatility, as the question here asks, I think maybe what we should do is look at the picture in the round. Is securities lending and short selling, does that add to market volatility, and see if we can answer that question. So first of all, let's look at what is short selling. Well, short selling is trading in a way that generates a profit if an asset price falls. Now, that's a pretty simplistic view, but I don't really want to spend a lot of time going into too many nuances, unless, of course, you and the audience want to go through that. So, look, imagine I'm a seller. I'm going to sell something that I don't own because I expect the price to fall in future, and I can buy it back cheaper. So what I'm going to do is sell it for today's price, and I'm going to hopefully buy it back in future, tomorrow, next week, next month. Hopefully I'll buy it back at a profit. And if I buy it back at a profit, good for me. I buy those shares back. I now have the shares. I give them back to you. I pay you whatever fees you're due, and we're both happy. Of course, if the share price goes up and it doesn't drop, then of course I lose money. But again, that doesn't really impact the lender. I still am going to buy those shares back at some point, and I have the shares. I'll close out the loan then, and the fees are what the fees are, right? So that's what it is. Why do people do it? Just very quickly, there's a whole number of reasons why. The majority of short selling, in fact, is for hedging strategies where you got an overall market exposure. So imagine, most of this year, if you went into 2022 thinking the market was looking a bit toppy, but you really liked your portfolio, you didn't really want to make any fundamental changes because over the medium term or the long term even, you think you've got a good portfolio. And yeah, 2022 might be bumpy, but you're willing to ride it out because you've got a portfolio of securities that you like. However, you don't want to just ride the storm downhill, and you want a little bit of protection. So what you might do is you might short sell something like the SPY or the Qs or an ETF that has a broader market coverage. And so if the overall market falls, you'll get some profit from short selling that. But it's really a hedge because you haven't changed your fundamental portfolio. So that's an example of hedging it. Arbitrage comes in many different shapes, colors, and forms. A very simple one is looking at the difference in price between any stock index and the underlying constituents. Stock indices are sort of theoretical numbers. They don't really represent how much it would cost you to buy and hold that underlying portfolio because, of course, you'd have commissions there. There might be withholding taxes on any dividends that are actually paid. And if you're holding the physical stocks, you have to hold them in custody somewhere. Someone's got to hold on to them, and often that costs money. So all of these costs add a little bit of friction into the returns. So an index should always generate a higher return than the cumulative price movements of the underlying securities. But they tend to trade in a reasonably predictable range, and occasionally they get out of whack. One becomes a little bit more expensive according to its historical trading range to the other. And so in that situation, you can short sell the expensive one and you can buy the cheap one, since they are linked by definition, the index and its underlying constituents. You don't have any exposure to the underlying securities, and you're just trying to capture what you hope will be a reversion to mean of its historical pricing differentials. So that's an arbitrage. So basically, it's a riskless arbitrage because you're short selling one, you're going long the other, and everything's fine. You don't really have any net exposure. And of course, the big one is the directional stocks, and the meme stocks are exactly that. So whether it was GameStop or AMC, the reality is the short sellers think that the share price is going to drop. And that may or may not be correct. And it's also not really a question you can ever answer. GameStop rocketed up and then it fell back, and then it's been up again and then down. And so that kind of movement gives you an idea of market volatility and how you can't really make it any one point in time to say you're a winner or you're a loser, because there's always people going in to buy them, to go long. There's always people that are actually short and closing up positions. And so, as I say here, really, the reality is not all short sellers and not all short selling is the same. Even within the short selling community, it's not really a community. They're all people that employ a trading tactic. And so they may or may not know each other. They may or may not have different or similar strategies. But look, people have been complaining about short selling since the very first short selling ban, which happened in the year 1609. That's a very famous date. The very first stock that was actually short sold was the Dutch East India company. There were all kinds of complaints about manipulation. Here we are over 400 years later, and we're still debating that. So I think that will no doubt come again from time to time. And in 400 years, I think we'll probably still be debating it. I'll come back to this question on naked short selling later, because that's the next question. But now it is, in fact, so let me just, before I do that, I just put in another slide here. So look, we've talked a little bit about what short selling is. What we haven't answered the question on is, does it actually make markets more volatile? I think there is a number of regulatory commentary. There's all kinds of academic study. And really what it talks about is short selling adds a few different things to markets. Number one, it adds liquidity in the sense that, first of all, market makers who make certain that there's a seller for every buyer, a buyer for every seller, they need to be able to short sell securities because they may not want to be, they may not have shares that they have to enable them to deliver to someone that wants to buy them. So there's an investor that wants to buy some stock. The market maker doesn't have any. There's none in the market there. What they're going to do is they're going to short sell to that client, borrow the shares in so they can satisfy the delivery to them and hopefully cover at some point in future. So market makers need it. Trading turnover, of course, is increased because if you have more people trading, whether they're long or short, there's just more market turnover. It also puts in what some people call a synthetic purchase, right? If I have a short sale now, what that means is at some point in the future, I have to buy that share back. And so it, in fact, puts kind of a floor into the future market. You know, there is another transaction that's sitting there waiting that has to happen at some point in the future. So it also supports liquidity in that sense. And of course, the original use for the vast majority of volumes really last century was to support operational transactions. So imagine I'm a stockbroker. My client has given me an order to sell some shares. They haven't delivered those shares to me in time. Whoever I've sold those to expects to receive them in the market. And if I don't deliver them, they now have a risk that I might go out of business. So what I might do to eliminate that risk is I might borrow the shares in and deliver those shares to my counterparty. That side of the transaction is done, and hopefully my client will deliver me shares in time. So from a liquidity point of view, it has a number of aspects. Price discovery is also a key element, where if you have opposing views, buyers and sellers, or potential buyers and sellers, commenting on a stock or putting orders in to buy or sell, you're more likely to get the right price for those securities. And that adds to the right price, because if you don't have that, what it also means then is that the only people setting the price for a stock are people that either own it and want to sell it, or people that don't own it and want to buy it. And so it's biased towards an upside, and it doesn't really have a full view of opinions there. So you're more likely to get the right price if there's more opinions being included in that. I talked about arbitrage a minute ago. And one thing that is really important to regulators that is sometimes hard to explain on screen like this. So imagine you have a market that just continually goes up. At some point, that market must be overpriced, because if a stock is up 10% this month versus last month, you have to ask yourself, the question is, well, is that company 10% better, more efficient, more profitable, more whatever than they were a month ago? 10% is quite a lot, but you can have 10% stock price movements. And so was it underpriced then, or is it overpriced now, right? If there's not a fundamental reason, one or the other has to be true. And so what happens is, if you have a market that continually goes up and up and up, or an individual security that goes up and up and up, at some point it must get past the stage of being irrationally priced. Nothing just goes up forever. And so what short selling allows is for, rather than that inexorable rise upwards, it actually adds for some of that contrary opinion to kind of smooth the top. Maybe the stock would have gone to $200, and you have short sellers that start coming in at 150 and 160 and 170, and it only really peaks at 180. So really, it kind of smooths the top. It stops everything from just going straight up. On the other side, if someone's been short selling and sorry, if the market's been falling and falling and falling, what happens is as markets fall, all kinds of portfolios get repriced. People get scared. Sometimes people are forced to rebalance their portfolios and reconsider their exposures to different markets. And so what happens is selling often creates more selling from peer investors. And so you have this this sort of self-reinforcing cycle of the shares have dropped, so I'm now going to sell mine because I don't want to be the last one out, which causes the shares to drop more, which means that other people are more likely to sell theirs. So you get that kind of unending self-reinforcing loop. And so what short sellers do, short sellers who no doubt have participated during that fall, they become the floor. They become the contrary buyers that actually stop it from just heading straight downhill and start becoming buyers that kind of smooth it out on the bottom. So whether it's short selling to mitigate overpriced stocks or buying bargains or closing up positions that they have to book profits from previous short sales, the short sellers actually narrow that peak and trough gap. And from a regulator's point of view, who wants less volatility, more predictability, and fewer wild swings upwards or downwards, it has some value there. And the final point here is that in most markets, you need to be able to confirm that you can borrow shares before you can execute a short sale. And what that means is there is a limitation on the amount of short selling that can happen because most people don't lend their securities, right? So the overwhelming majority of portfolio holdings, maybe 50, 60, 70, 80% of the investors don't make their shares available for loan. And so that in itself caps the amount of short selling that can happen in a given security. So market efficiency, liquidity. So does it lead to market volatility? No, I would argue that in fact it reduces market volatility. However, at short periods of time, short sellers can have a major influence on price movements of specific securities, right? So short term, it is possible that short selling supported by securities lending can destabilize a market momentarily. But again, the vast majority of investors are actually long holders. And so it's only from time to time, and it's typically by individual securities rather than as a market. Short sellers just aren't big enough to impact an overall marketplace. Okay, so that's 2 questions and time for the first giveaway. That first giveaway is, what is that first giveaway? I'll tell you in a second. Look, there's even more slides. So is short selling good or bad in securities lending? I will get to the giveaway in a minute, right after this slide. Of course, a lot of people think it's a little bit immoral because the way it generates a profit is that the target company that they've short sold, in fact, underperforms their company. So that company hasn't hit its goals. It hasn't generated enough sales. It hasn't done enough, efficiency improvements, whatever it is. So some people think it's bad to actually be able to profit from that. As I said a minute ago, it can also cause short-term distortions. The other thing it can do is also get rid of, expose fraud or bad practice at companies. Now, a lot of people don't like that, right? If I'm an investor in a company and someone else points out that that company is doing something fraudulent, that share price is going to drop through the floor. And I'm not going to be thankful for them, even though they've pointed out something that might even be illegal, if not misleading. So not everyone likes that. One of the issues is that short selling is typically only available to institutional investors like hedge funds, but increasingly a wide community of institutional investors. So is it in that way biased in favor of a select few? It's certainly riskier. Short selling is not the opposite of going long because there's an unlimited loss potential if you short sell. Whereas if you buy a stock at $10 and it goes to zero, the most you can lose is $10. If you short sell a stock at $10, it can go to $100 or $1,000 and you can use quite a lot. And of course, short selling, like any transaction, can be open to abuse or manipulation, just like pump and dump situations where people buy a stock, ramp it up, talk it up big, and then sell the stock, leaving the bag holders to suffer any subsequent falls. So any transaction type can be open to abuse or manipulation. The good things, of course, it adds perspective to market prices, as I said, adds to volume and turnover. And the positive side is we don't really want a whole bunch of fraudulent or bad practice companies really thriving in markets, do we? I certainly don't. And of course, since it can be a hedging tool, as I described earlier, it is also a risk management technique, and it's increasingly available to a wider audience, including retail investors. There are some brokers that now offer that to their customers. Okay, here you go. Here's the first giveaway, finally. I know you're all saying, oh, it's about time. This first video. So look, the whole reason I've got 1,000 subscribers is because I've had the support of everyone that has taken the time to watch, view, and then maybe give me a like. And so if you're actually thinking that this is helpful, please give me a like. But of course, I'm only doing these videos to meet the needs of those viewers that want them. So what I'm interested in is finding out from you which videos you want to see. And for each course idea that I agree to turn into a video, not a course, as it says here, I'm going to give you a free course for every idea that I agree to turn into a video. All you have to do is enter your video ideas into the comments. And as I say, I'll be looking at those for the next week. So if it looks like a good idea that I think I can do a video on, then you will get access to my free course, Introduction to Securities Lending. It's way more than an introduction. I don't know why I called it that, because I go into basically 10 different chapters, look at everything in the business. Even if you're in securities lending, it's likely that you're in one part of it. You might be a trader. You might be in operations support. You might be a salesperson or a relationship person. The idea of the course is to give everyone a broad understanding of how the institutional securities lending business works. I'll keep that open until the 4th of November. So if you want to do that, I'll give you access to the course. Okay. Right. Now let's go on to the next question. Let me just get that up for you. Can I still vote if on my stocks if they are on loan? So I'm an investor, I hold shares, they get loaned out. Can I still vote those shares? This is, and all these slides that I'm using in this session are from previous videos that I've done. So you may have seen some of these things before. But what I've done is I've highlighted here that the original owner, so that investor, when they lend securities out, they keep all the economic benefits of it. So if it goes up, they'll still profit from that. If it falls, they'll still suffer that loss. But the one thing that they have to give up is voting rights, because if I own a share and I have it registered in my name or my broker's name, then I'll be able to vote that share. If I lend it out to an investment bank who gives it to their hedge fund client, well, I no longer have those shares in my name. They have the shares, and whoever probably the short seller was that bought it from that end hedge fund, well, they're the ones that actually get the vote. So technically, no, you can't vote those shares. However, However, as I say here, you can ask in almost every transaction, loan transaction, you can ask for the shares back with a notice period. And that notice period is usually one settlement cycle. So in many markets, that's 2 days after trade date. So if I sell something on a Monday, I can have it back on a Wednesday, right? So most transactions can be closed out. So if I decide that I want to vote the shares, then all I have to do is ask for my shares to be returned to me. 2 or 3 days later, they'll actually be back in my hands and I can vote them again. So voting can happen. And look, for an institutional investor, they're important investors in a lot of companies. So prior to getting involved with securities lending, and this is the kind of thing I help people with, they'll want to set up some kind of a policy that says, if I'm going to be in a lending program, these are the sorts of corporate issues that I'm interested in voting on. And these are the ones where they're not really that important. So I don't care about the vote. And it's more important to me to generate fee income than exercise my vote, because I don't think that that's an important issue, or it's not meaningful, or my own holding isn't big enough to really have an influence. So, the thing is, when a stock is on loan, maybe it announces a dividend while it's on loan. Well, whoever's borrowed those securities just gives you the cash equivalent for how much you would have got as a dividend. So you're kind of made whole. Even though you don't get the real dividend, you get what's called a manufactured dividend. Economically, that's the same to you. But of course, a vote doesn't have any kind of economic value that you can ascribe to it. So the borrower can't just give you cash in lieu of the vote. And so for an investor at an overall level and at an individual security vote level, they need to have some kind of a way of determining whether they're better off to get the shares back, vote them, or to continue to collect fees. So can I still vote my stocks if they're on loan? No, not while they're on loan, but you can get them back. Okay, hope that makes sense. The next question is related to naked short selling. What's the difference between naked short selling and short selling? Let me go back to that slide that I showed you a minute ago. So I also mentioned with short selling that in most jurisdictions, before an investor can do a short sale, they have to make certain that there are enough shares available for them to borrow before they do the short sale. That's to make certain that there's no systemic risk. If I don't have any kind of a constraint and I'm a naked short seller, I can just put an order in the market. I'm going to short sell 1 million shares in the market, and it will look really weird on the screen. You'll see an order imbalance that someone wants to sell 1 million shares, and maybe the daily turnover is like 100,000 shares. And so that would distort and have an impact on market prices. So that would be a bad thing for it. And so a lot of regulators and a lot of markets require you to be able to borrow those shares, or be able to confirm that shares are available to be borrowed. You don't necessarily have to borrow them. You need to know that there's enough shares there available to borrow. If I can verify that there's shares to borrow, I can then go do my short sale. As I said a couple of minutes ago, you're still constrained because there has to be enough shares in the market for you to be able to do that size. But I've got that. So, but now I have the confidence of shares in the market. I can do my short sale. I can borrow those shares. I can deliver into the market. That's a covered short sale or a short sale. A naked short sale is where that would-be short seller doesn't try to see if there's any shares in the market. They don't care. I'm going to put an order in the market to short sell. And as I said a minute ago, unless you can be certain that there's shares that will be available to cover that short sale, there's a potential risk in the market, and a potential systemic risk, and a price distorting potential for that short sale. So that's a naked short sale because you haven't covered it by knowing that there's shares available. And naked short selling in many equity markets is in fact illegal, now. Hasn't always been the case. And in many government bond markets, it's not good practice, but government bond markets sometimes do allow naked short selling. It's a very different market to the equity markets. The players and the participants are very different in that. So it's a different situation. I had a question come in. What is short arranging? So that's not a commonly used term. So I'm not certain exactly what you're referring to there. But I think it's probably the same thing. What they're doing is they're arranging to make certain that they can cover the short sale with that. As I said, though, I'm sorry, I'm not familiar with that term. Listen, I did my first stock loan in 1981. So I think I've been around for a little while and I've heard a lot of things. Unfortunately, I'm not familiar with that. So if you can put some more information in that, that would be great. Or you can just send me an email. I'll be posting up my email in a little bit, and you can send me a question and we can explore it further there. Okay. So that hopefully answers a question about the difference between a naked short sale and short selling. So we've now looked at 2 more questions. Can I still vote my stocks if they're on loan? And what's the difference between naked short selling and short selling? So that must mean it's time for another giveaway. So what I'm going to do here is this book here that I'm showing on screen is an introduction to trading strategies that involve securities lending. So what we do in that book is we go into some very high level explanations of different trading strategies that are used often by hedge funds, but it doesn't have to be hedge funds, that involve securities lending activity. So we give a little bit of an explanation and a breakdown of that. As I said, I will give this book to, and it's an ebook, and I will send this ebook out to the first 5 people that put in the comments the word ebook. So this is whether you are watching live or if you're watching a replay, just whoever the first 5 are in the timeline will give you that book. It was written by a colleague of mine, Jeroen Bakker, that did a great job with the book. Unfortunately, he's gone on to bigger and better things, and he's no longer working with us, but still a good friend and member of the team, and did a great job with that book. Okay, so that's the second giveaway. So the first one is about courses. If you give me video ideas that I think are good ideas for videos that I can do, I'll give you access to my course. The second giveaway is an ebook, so you can look at trading strategies that involve securities lending. Okay, the next question is about fees. And let me just see. So since people want to know before they get into lending, how much money am I going to make? And that is possibly the toughest question to answer that there is, because one thing that everyone that knows me and has been around will know is that I hate averages. I just hate averages because they're never really very meaningful, particularly in this business. The description I use and why I don't like average is, imagine you're sitting there and you have one foot in a bucket of ice water and you have another foot in a bucket of boiling water. Probably on average, you're going to be okay. But that isn't what your experience is with either foot, right? So the average number is misleading. The same can be true with securities lending. So what I put up here is something from S&P Global Securities Finance, part of the market intelligence business at S&P. And what they've done is, for the month of September, here's their chart in the different sort of broad categories of different equity groups regionally, exchange traded products. That's what the ETP is. The government bonds and corporate bonds. What they've done is shown how much revenue have been made in the years. So that's $1 billion for the month. I just finished a video last week about a review on revenues and performance. What this chart also shows, though, is total value of securities that are on loan in their database and what the average fee is. So this is basically 0.45%, means just under 0.5% a year in fees. So you can see the high priced ones are American depository receipts, almost 1.5%, but pretty high returns overall. But that's really a broad guide. That applies almost certainly to no individual security. So it really depends on which stocks you're holding. If you go back to the video that I showed, I also flashed up, courtesy of these people, the highest performing individual stocks and bonds from the month of September. So you can see which securities generated the most fees and the highest returns for that month. So you'll be able to see on demand, or so you'll be able to see what the demand was for those securities in that month. And one of the anomalies is that you get some securities that are continuously in demand or often in demand, and then you have one-off spin-off transactions. Last month happened to be one in the Americas. 3M spun off a part of their company, so there was an arbitrage opportunity there, and people paid quite a lot of money to borrow 3M shares. That was that month. Transactions done. Unlikely we'll see that again. So this will give you an idea of very high level returns. Go to my previous video, which I'll put a link in the notes to afterwards, and you'll be able to see the full video that talks about performance. And the last question that we received before the show is, what's the difference between repo and securities lending? Another really good question. What I've put up here is a summary from another video that I did. I guess I've looked at it really in a number of different ways. So if you think of the reason for a repo transaction, it's really one party has cash, another party has securities, and the party with the securities wants to borrow money to finance that position. All right. So I'm sitting there, I've got an asset, I own that asset, I get whatever performance is related to that, but it's just a dead asset to me. So if I can borrow money against that asset, then I can use that in my daily operating environment. I can use it to, pay bills, meet my financing costs, reduce overdrafts, whatever it is. So repo is about lending and borrowing cash secured by securities, stocks or bonds. Securities lending is typically a collateralized loan. So again, you're getting protected against your loan exposure, but it's a specific asset. If I want to borrow shares in Ford Motor Company, giving me shares in General Motors isn't going to do the trick because I'm looking for Ford shares. I'm not looking for General Motors. In a repo, since the real objective here is to borrow money, what the collateral is just has to be similar assets. So if it's one government bond as collateral, and the provider of that government bond needs that bond back, what they can do is they can always ask if they can substitute that bond. So if I have a German government bond as collateral and I need that back for my trading purposes, what I can do is I can substitute that with a French or an American government bond, and everyone's happy with that. And you arrange that at the beginning of the loan. When I say I'm going to lend you $1 million, you say, great, Roy, thanks very much. Can I give you government bonds? And I might say, well, which ones do you have? And we'd agree which ones would be acceptable to me. So that's all done. So the asset that's in demand is cash, and the collateral is a wider group. In a securities loan, the asset that's in demand is a specific stock. And against that, the counterparty has to provide collateral. And again, we'll agree a broad range of collateral types that might be acceptable. Okay, so one's driven by cash, that's a repo. One's driven by security, and that's securities lending. Now there's collateral. Who gives the collateral? Where in a repo, since the asset that's in demand is the cash, whoever's borrowing that cash has to give an excess of collateral. In a securities loan, since the company shares that are in demand, that in my example is Ford. I don't know why I picked Ford, who knows, but I did. So in that example where it's Ford, I need to borrow those shares and I will agree whatever the collateral is. So if I'm borrowing these shares, I have to give an excess of collateral to whoever's giving them to me because I want that asset. The fees in a repo transaction, it's kind of like a loan, a cash loan, since that's what it is really. And when that loan is paid back at the end of that period, then the borrower of the cash pays back the interest. Securities lending, on the other hand, is we'll have a loan outstanding over the course of a month. At the end of the month, the two counterparties agree how much money is owed, and then it's reconciled and paid monthly in arrears. Okay, so in a repo, it's a cash loan. You pay the interest at the close of the transaction. On a securities loan, it's calculated and paid 1 month in arrears. Okay. The other thing is just on the fees. Typically, a repo transaction is fixed. It's set. So the terms and conditions and period is set right when you do the loan transaction or the repo transaction at the beginning. At the close, at the close of the transaction, nothing's changed, right? So it's X amount of interest on top of the cash borrowing amount times the interest rate times the number of days. That's a closed transaction, and you pay that when it ends. For a securities loan, one of the things you can do is, since it's continuously an open transaction, either side can cancel it, as I said before. If the supply-demand dynamics change, something that was really in demand before and therefore generated a high fee, if that all of a sudden that demand drops off, the borrower can say, I'm still interested in borrowing it, but I want to pay a lower fee. Or the lender can say, I made the loan to you when there wasn't much demand for this stock. There is now a lot more demand. I want a higher fee. So you can renegotiate the rates throughout. And in terms of the tenor, repos are fixed term. They're generally short durations. You know, overnight loans are probably the biggest, followed by a week and then a month and then 3 months. But repo transactions can go for months and years in some exceptional cases. Whereas the securities lending transaction, that's empty because it's open. The securities loan transactions are open. It might be outstanding for a day, might even be intraday. Not so common, but it could be next day, or it could be for years, right? So it's open. Either side can cancel it whenever they like. So look, that's it for the recorded questions. And I don't see, other than the one that we received a minute ago about the short arranging, I haven't seen any new questions come in. And now what we have is the final giveaway, right? So if you just let me get rid of that. So the final giveaway is a one-on-one 1 hour free session for securities lending with me. I do coaching as part of my consulting business. So if you want 1 hour of my time free, send me an email. Let me know why you want to have that hour, what your objective would be, and I will pick one lucky winner of that. So you have a week to email me, 4th of November, midnight UK time. So I look forward to receiving that. So let me just finish that. So that's it. Unless someone comes up with a question in the next 15 seconds, that's going to be it. Once again, thank you to everyone that's been a subscriber. If you think this has been helpful, this video, please give it a like. Share it with your friends. And if you want to be advised about future videos, please press the little bell that will hopefully make certain you get identified every time I post a new video. So that's it for me. Thanks again. Over and out.